Okay, so recently I've been hinting that I think the market could crash, but I've hesitated for making any bold predictions, partly because I'm not smart enough to predict where the market will go, and partly because not betting with the market is a foolish thing to do 99% of the time. I'm a big believer that the best way to grow your money over many years is to bet on the market going up in the long term. However, I want to take a moment to share my thoughts with you honestly and be completely transparent. There are things happening in the market right now that you probably don't know about. Once you hear about this, you might think differently about investing. So don't invest anything more until you've at least heard what these things are. So let's get straight into it. You don't need a reminder of what's been going on. There's a pandemic, the economy is tanking, but the stock market is still somehow rising. There you go, we're all caught up. So let's dive in. The stock market is a bubble. Bold claim, right? Well, you see, there are consistent patterns that emerge in every bubble in history, and these consistent patterns are emerging again right now. Now, I know what you're thinking, consistent patterns in every bubble. That sounds like it doesn't really make sense. If the same patterns emerge in every bubble, surely we wouldn't repeat the same mistakes again and again. We just look back to the past and avoid the mistakes people made last time, right? Well, unfortunately, we don't learn. And we don't learn for one reason. And we're going to cover that shortly. But first, let's take a look at what these patterns of a bubble are. On the left of the screen, you can see a chart. This chart shows the stages of every bubble in history. In the beginning, you have the early stealth phase. Next comes the awareness phase, as the investments begin to attract attention. After this comes the mania phase. And finally, the blow-off phase, or the crash as we'd call it. You see, what's really interesting here is that this chart shows pretty much perfectly how every single bubble in history has grown and burst. On the right, for example, you can see the dot-com bubble. Notice how the chart looks pretty much identical. So, did people learn from previous bubbles? Well, maybe, but clearly not enough to avoid it playing out in the same way again. On the right now, you can see the railway bubble, which is where I'm from in the UK, and this was all the way back in the 1800s. Again, the same chart. Finally, we have the Bitcoin bubble. This time it's overlaid on the stages of our bubble chart, and we can see how closely it does follow it, i.e. it is the same pattern. So whether it was the railway bubble in the 1800s, the dot-com bubble, or the Bitcoin bubble, the truth is we never learn, and we repeat the same patterns over and over. In fact, I have to hold my hands up and say that I made many of these same mistakes in the Bitcoin bubble. So why do we make these mistakes again and again? And most importantly, how do we avoid them in the future? These same patterns repeat because every now and then we invent something that changes the world, and we think, this time is different. You see, people often think of a bubble bursting as the end for something, but the three examples were, well, number one, railways. I think it's pretty clear they were a success and the bubble bursting was not the end for railways. Number two, the internet. Again, it changed the world we live in today. And number three, Bitcoin. This is obviously the most contentious out of the three, and maybe you'll disagree with me on this, but Bitcoin has shown tremendous staying power since the bubble burst, as we can see from this price chart since, and simply hasn't had as much time as the others to prove its worth. But that's for another video. The key point is that we always fall victim to the same patterns because we think this time is different. Those are the key words which have caused every bubble in history to get out of hand. In fact, this is a well-documented thing, with lots of analysis actually carried out on the "this time is different" syndrome. And guess what's going on today? Well, apparently, this time is different. We all know that the stock market and economy have gone for a long walk in different directions lately. But what you probably don't know is that we have clear signs that we are currently in the mania phase of the bubble chart. And as we can see, the crash usually isn't too far behind. Let's get specific. Well, in the mania phase of a bubble, all logic and rational thinking go out of the window. In the dot-com bubble, professional investors were saying things like, we're in an environment where the company doesn't have to be successful for us to make money. The company doesn't have to be successful for us to make money. Yeah, That sounds sustainable. In fact, investors didn't even want internet companies to make money. I'm not actually kidding here. In fact, to quote, "The last thing I want is to be profitable, because then I wouldn't get a valuation of an internet company." In other words, if the company didn't make money, you could say it's worth any number you can come up with. But the moment it makes a profit and you realize the company is valued, say, 1,000 times more than the profit they make, you'd realize that the company is overvalued and the price might start to crash. So internet companies that made money were worse for investors than internet companies that lost money. Just let that settle in for a second. It gets even worse. Companies were changing their name to add .com or the word internet, and their share price would increase by an average of 74%, even though the company itself would be the exact same company as before. They'd just added a few letters to their name. Funnily enough, we saw the same thing with the Bitcoin bubble. Companies were clambering over themselves to claim that they are associated with the blockchain technology, which is the technology that underpins Bitcoin. Take the company Long Island Brand Beverages. They manufacture iced tea. Until the blockchain hype took over, and then they changed their name to Long Blockchain Corp. And naturally, their shares jumped by a crazy 289% shortly afterwards. Okay, so that's clearly insane. But what's going on today that reminds us of this? Well, today we have another crazy trend. This time though, it's with bankrupt companies. Companies like Hertz and JCPenney are declaring bankruptcy, and then their shares skyrocket in price instead of crashing. So I've actually been researching what happens in bankruptcy recently, as I'll be honest, I wasn't too sure myself. Essentially, when a company announces bankruptcy, the shares have zero value. Now, I know what you're thinking. What if the company survives bankruptcy in the future? And what if Hertz, for example, can cut some costs and make it through to the other side? Again, I'll be honest, I wondered the same thing myself. But it turns out that the shares are nearly always deleted during bankruptcy. The shares are just completely wiped out. You see, if the company does survive, the people who loaned the company money in the past create new shares for themselves. These new shares they don't give to the old shareholders. United Airlines, for example, went bankrupt in 2002. 4 years later, in 2006, the company exited bankruptcy and the shares went public. These same shares are still trading today. But here's the thing, these shares were new and weren't given to the old shareholders. So the people who held shares before and during bankruptcy lost everything. It doesn't matter that the company survived. So if investors are buying shares in Hertz, hoping for the company to survive all of this craziness, it doesn't even matter if the company does survive for the current shareholders. Because if they do, the company will simply issue new shares and they won't give you any of them. But somehow, this isn't even the end of all of the craziness. This isn't even the peak, in fact. Because Hertz have recently announced they will be selling $1 billion worth of shares to retail investors. Remember, these shares are almost certainly worthless, even if the company survives. So, Hertz will soon be selling $1 billion of worthless shares. You couldn't even make this up. So, why are Hertz selling these worthless shares? Well, as the company puts it, the recent market prices of and the trading volume in Hertz's common stock potentially presents a unique opportunity to debtors to raise capital on terms that are far superior to any debtor in possession financing. Let me translate that for you. Hertz have realized that most regular people like you and me, don't know that shares are completely worthless the moment the company declares bankruptcy. As I say, I didn't know this was the case until a few days ago myself. And so the company wants to take advantage of our naivety by selling us $1 billion of a worthless item. But it gets even worse. The company are currently fighting to stop their shares from being delisted from the New York Stock Exchange. You might not even be allowed to sell them soon. And off the back of all of this, Hertz's share price increased a further 50%. Honestly, I have no idea how this is even legal. Hertz will essentially be ripping off regular people like you and me who don't understand bankruptcy. And let's be honest, that is most of us. So what we're seeing is that companies are announcing that they're bankrupt. In other words, their shares are worthless. And on the day that they announce this, the shares somehow increase in price. And now Hertz are planning to carry out the first ever IBO, initial bankrupt offering, where they will be selling $1 billion of worthless shares to investors. I don't know about you, but to me, this sounds about as crazy as any bubble in the past. So in my opinion, we have the mania phase clearly present. But why is this time different? Remember, every bubble is born out of the fact that investors are happy to ignore history because they believe this time is different. Well, today we have Jerome Powell, the Fed, and the money printing machine. Okay, so we've seen money printing or quantitative easing in the past, but let's just have a quick reminder of how much money is being printed right now. In 7 years, from around 2008 to 2015, the Fed's balance sheet increased by around $3 trillion. In 2020 alone, the Fed has already printed nearly the same amount of money in 2020 alone compared to 2008 to 2015, a 7-year span. So the concept of money printing isn't new, but the amount certainly is. In fact, you'd be hard-pressed to find anybody who expected so much money to be printed so quickly. Add in that the Fed has decided to start loaning money directly to companies for the first time ever, and we have reasons for investors to believe maybe this time is different. So we have the two clearest signals that we get when we're in a bubble. We have complete and utter craziness where logic has been thrown out of the window. And we have people saying that it doesn't matter because this time is different and so we can't apply logic of the past. So the question is, what should we do? Well, here's the thing. Even if the market is a bubble, we have no idea when it could burst. So the market could continue growing, and I'm not going to sit here and recommend anyone sell their shares. In fact, as much as my instincts are telling me that the bubble must burst soon, I try to use maths and data in my analysis as much as possible. And the data always shows us that we cannot time the market. So even if my instincts say that the market must crash soon, I have to recognize that my instincts might be wrong. So timing the market is out. But there are still some tried and trusted investing strategies that investors have used in the past to protect themselves in times like these. The most important thing for investors is to be well diversified. If I asked you, what are you invested into? What would the answer be? Would it mostly be the American stock market? Perhaps an S&P 500 index? If it is, I understand. It's been basically the best investment of the past 100 years, and I'd expect it will be the same again over the next 100. But here's the thing. Investing into the S&P 500 only means that you're well diversified across the American stock market. That's not really diversified. To be diversified, you should be invested across many different countries and across many different types of investments. As Ray Dalio says, for example, investors should look at unique investments such as gold as an insurance policy in case of a crash. So as boring as it may sound, diversification is the key. If you have many different investments, you don't need to worry as much about market booms or a bubble bursting, because proper diversification means that your portfolio will be protected as best it possibly can in all situations. So I've actually put together a few videos looking at what the world's best investors, people like Ray Dalio and Warren Buffett, are investing into right now, and how they are using diversification to protect their money. So if you want to learn about what the world's best investors are doing right now, people much smarter than myself, click up here. Thank you for watching.